Good afternoon and welcome to the final session in our autumn term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center at the University of Buckingham. I'm Dr. Juan Castañeda, Director of the IIMR, and today we'll be hosting Ryland Thomas. Ryland is a senior economist at the Bank of England, where he has worked for over 20 years. In that time, he has worked in a number of roles analysing both monetary and macroeconomic developments in the UK. He also spent 6 years in the bank's forecast and modelling teams. Ryland's research has mainly focused on the role of money and credit in the economy and has largely involved using empirical time series methods. Ryland has also researched the impact of QE, fiscal policy and oil price changes on the UK economy. Additionally, he has a research interest in the UK's economic history and the use of archival data in examining the past behaviour of the Bank of England. Currently, he looks after the Bank of England's historical macroeconomic database and the data on the Bank of England's historical balance sheet. He also chairs the Historical and Monetary Financial Statistics Network of Central Banks, hosted at the Bank for International Settlements. He's currently seconded to the Economic Statistics Centre of Excellence and is working on a project which aims to reconstitute a comprehensive set of UK historical data on national accounts and other macroeconomic and financial variables over the past 100 years. Ryland Thomas will discuss today the Bank of England as lender of last resort in the 19th century, after which we'll allow time for a Q&A time with viewers from home. Today's presentation will be recorded and made available on our YouTube channel. Questions must be submitted by the chat option, and I will moderate them and address the speaker. Ryland, we are very grateful for your continued support to the Institute over the last few years, and we are delighted to host your seminar. The floor is entirely yours.
Okay, so thank you very much, Juan, for that very kind intro, and hopefully everyone can hear me and see the screen. So thank you again, Juan, for giving me an opportunity to present some of the bank's historical research at the Institute's Money webinar series. Now, like other central banks with a long history, there's an enduring interest in financial and economic history at the Bank of England, and this has only intensified since the financial crisis, where the past naturally has a lot to offer in terms of natural experiments. And the talk I'm going to be giving you today will be on the bank's role as a lender of last resort in the mid-19th century. Now, the talk will be based on several papers I've written over the past few years with several colleagues, Mike Anson, David Bolat and Miao Kang at the bank, and Kilian Ryder, who's now at the Central Bank of Austria. And many of these papers will go into a lot more detail on some of the issues I will talk about today. My aim is to give you a flavour of what we've found so far amongst our research, our various bits of research into this particular issue. Now, one motivation for the project has been to try and exploit the information in the bank's archive. Using the archive to help inform policy has been an important part of the bank's research agenda since it was launched in 2015. And the bank's archive contains an enormous amount of information, especially about the bank's role as a lender of last resort in some of the key financial crises of the 19th and 20th century. And a lot of this information is mainly in the form of transactional ledgers that you can see here on the right, which records all the dealings the bank had with key counterparties. And it's analysis of this material that forms the basis of the papers that I mentioned a minute ago and what I'm going to present to you now. Now, there are sort of two basic questions we're using the analysis to look at. The first is a historical question. The financial crises in the mid-19th centuries are what you might call the formative years of the bank's lender of last resort role, leading up to the publication of Bagehot's famous treatise called Lombard Street in 1873, where he set out the basic principles of what a lender of last resort should do. So do we see those principles emerging in practice during these crises in the mid-19th century? That's one question of interest. The second one is obviously a policy question for the bank today. Do we see echoes of the bank's behaviour in the 19th century in the bank's current response to some of the issues that we've experienced post-financial crisis in terms of liquidity and collateral management? So those are the sort of two questions we're interested from this research. Now, just to expand on the historical question a little, there have been many interpretations of Bagehot's famous rules that he set out in Lombard Street. Perhaps the most oft-used rendition of the rules is that in a financial crisis, a central bank should lend freely at a high rate of interest and to solvent borrowers with a subtext of on a limited set of good collateral. Now, these rules have been highly debated amongst historians and economists in terms of whether actually Bagehot said these things explicitly in Lombard Street, what he meant by them if he did, and whether these are indeed the right principles a lender of last resort should follow. And I've listed some of the various motivations for these rules that have been put forward in the literature, but I'm not going to rehearse all of those arguments now, given the time. What I'll do here and what we do in our papers, I'll use Bagehot's rules as a sort of convenient reference point or organising framework to help us analyse what the bank's ledgers can reveal about the bank's behaviour in the 19th century crises and how these compare with Bagehot's prescriptions. Now, perhaps the most debated of Bagehot's rule is the one on lending to solvent borrowers on good collateral. And in the historical literature, this has boiled down to a debate about how the bank's discount office, the sort of way it interacted with the private sector, how that discount office operated in practice during the 19th century, particularly in terms of how it evaluated the bills coming in for discount for outright purchase by the bank, but also the bills coming in for collateral offered on loan applications. And in particular, did the bank operate under a fixed set of rules, or did the bank operate with some discretion? Now, under one view, the bank did not actually care who came into the bank for assistance. All that mattered was the quality of the paper coming in, either for outright purchase or as collateral for a loan, and whether that collateral satisfied certain criteria. If the bills of exchange or instruments that were coming in met a certain set of rules or criteria, then they would be discounted. And this question was nicely posed by Forrest Cappy in terms of whether the bank's discount window was made of frosted glass. Was it necessary to know the identity of the discounter, the person coming in for funds, when granting assistance, or was the quality of the paper all that you needed? On the other hand, in more recent work, Flandre and Ugolini argue that the glass was necessarily more opaque than frosted. The key money market security at the time and the instrument the bank was dealing with was the bill of exchange, a debt instrument underwritten by a number of endorsees or names. Now, the bills of exchange coming into the bank for sale or as security for loans were not really backed up by any real goods or assets, not explicitly, but they were rather backed up by an interlocking set of assurances by all the parties who had endorsed the bills. And that included current and previous holders of the bill, including obviously the current holder who was bringing it in for discount. So the quality of the paper was therefore bound up in the names of all the parties who had endorsed a bill. They all mattered, including the discounter. So the bank arguably needed to know the counterparty and who was coming in for assistance, and use that information to apply discretion in its lending behaviour. And that's one of the questions that the ledger material, as I'll show you, is able to help us address. Now, evaluating these historical arguments of collateral management echoes the recent position the bank has faced after the crisis of 2007. So it links into that second policy question that I mentioned at the start. So prior to 2007 in the UK, we thought we had a good framework of liquidity provision based on offering funds against a relatively narrow set of collateral. But we had to improvise and modify our approach to liquidity provision after the financial crisis. We introduced QE and funding schemes for banks, and we paid interest on reserves to ensure we retain control of interest rates while allowing us to expand our balance sheet to implement QE and those funding schemes. We also accepted a much wider set of collateral in our operations, and so monitoring collateral is a key part of the bank's risk management at the moment. And there are also broad questions about whether liquidity provision should extend beyond the traditional banking system to shadow banks and other financial market participants. So the policy question is, are there lessons we can learn for the current operations of the bank that we can make from looking at these previous financial crises in the mid-19th century? Now, a fair challenge to our project is why we are confining it to the period, the mid-19th century, the period after 1847. Now, some have argued that the bank acted as a lender of last resort much earlier, in fact, almost since the start of its existence during the 18th century. And there's a well-known paper by Lovell in the 1950s that argued the bank was operating something like a lender of last resort policy during the crises of the 18th century. And he used annual data on the bank's discount activity, shown here, and showed that in some of the key crises, which are marked by the grey stalks in this chart, the bank does appear to have increased its lending markedly. Not in all of them, but in some of them. Similarly, many have pointed to the actions of the bank during the early 19th century crises, where again the bank seeks to increase its lending during crises, highlighted here by the red circles. And obviously during this period, we know that contemporaries such as Francis Baring, Henry Thornton began to articulate the role of the lender of last resort, or the bank's potential role as a lender of last resort, in anticipation of Bagehot's treatise later on in the 19th century. However, one reason for not looking at these earlier crises was that bank rate was not an active tool of policy prior to 1833. Now, one of Bagehot's rules was lending freely at a high rate of interest, but the bank was actually prevented from increasing interest rates above a limit of 5% imposed by the usury laws. So the bank was unable to follow Bagehot's prescriptions and lend freely at a high rate until the mid-19th century. So that's one reason for looking at this, focusing on this period. Another reason for looking at the situation in the mid-19th century was that arguably it has similarities to that faced before the great financial crisis in 2007. So in 1847, there was a widely held perception that monetary stability was sufficient for financial stability. The emphasis on monetary stability was embodied in the 1844 Bank Charter Act, which linked the bank's note issuance directly to its gold reserves. It was felt financial stability had been solved after the earlier 1825 crisis by allowing larger, less vulnerable joint stock banks to emerge, and which were not allowed to issue notes. But actually, the growth in the size and interconnectivity of financial institutions after 1825 generated relatively unforeseen systemic risks. There was the rapid growth of provincial and London-based joint stock banks in the 1830s and 40s. And there was an associated growth of bill brokers, many of whom became dealers in bills and would ultimately become what became known as discount houses, where they actually held commercial bills of exchange on their own account, funded by money it called held as liabilities to the banking system. Now that meant a growth in broader measures of money, both bills and deposits, which wasn't a feature of the 1844 Act, which emphasised control of notes issued by banks and said nothing about the quantities of bank deposits or bills. Now, one might argue this is very similar to the collective mindset in the lead up to the great financial crisis. There was an emphasis on monetary stability in the UK with the inflation target and operational independence of the bank. But we had these increasing risks arising from the financial sector, demutualisation of building societies, securitisation of new instruments, mega banks and shadow banking, and which led to a certain amount of asset price inflation leading up to the great financial crisis. Now, as a result, the risks from growth in broad money and credit were possibly underappreciated over this period, apart from, of course, a certain Professor Congdon, who may be listening to this presentation. What you could argue is that there is a fairly apposite comparison between the early 2000s and the mid-19th century experience than there is possibly with earlier periods in the 18th century. So a comparison of the mid-19th century with the early 2000s is a useful one to look at from that perspective. Now, most important, however, is that it's only from the mid-19th century that we have good quality microdata on the bank's actions in financial crises from the bank's archive in the ledgers that I showed you earlier. And that basically allows a deeper statistical and econometric analysis of the data. And the advantages of the ledger data are they're at high frequency. We have daily transactional data available, which is especially useful for financial crises, which may only last a number of days and weeks. We have rich counterparty information. We have a lot of information on the bank's exposure to the financial institutions that stood behind the bills of exchange, that were the key instrument via which the bank lent to the private sector. And we have both price and non-price information. So we have rates of interest, implicit rates of interest on the discounts of bills and on the advances, which represent short-term loans secured on those bills. And we also have information on maturity and bills rejected. And to give you an example, this is an excerpt from the daily transactional ledgers from May the 11th, 1866, the day after the financial house Over and Gurney suspended payment, which is when the financial crisis of this year begins. And basically, this shows you all the counterparties attempting to discount bills of exchange with the bank, and including what rate they were charged and any bills that were rejected to discount by the bank. Now, one thing to note is that when counterparties came in for funds, they brought in whole packets or parcels of bills, sometimes running well into the hundreds, which the bank would then discount at or charge a single or possibly two rates of interest. So in some sense, these packets are a little bit like modern day CDOs or mortgage-backed securities, in the sense that they contained a bundle of assets that the bank would have to evaluate in a short space of time and evaluate the quality of those assets in order to come to whether they were going to accept the bill and what rate it would charge. Now, although the bank had a minimum discount rate, it frequently discounted bills at a range of rates as well. And on this particular day, there was a range of discount rates of between 10 and 12%. And I'll say a bit more about this a bit later. Now, to examine how the bank might have monitored its collateral and the quality of its collateral, we need to look at a different set of ledgers, which are called the customer with and upon ledgers. And this allows us to unpack the packets of bills that customers would bring in and look at the characteristics of the bills themselves. And the chart here shows you an excerpt from Rothschild's customer ledger, and the highlighted area shows a parcel of bills that it brought in on the 12th of October 1847. And this slide shows you an example of how the daily discount ledgers and the with and upon ledgers are linked. The slide on the left shows you an entry for the 20 bills that Bieber & Co. brought into the bank for discount on that day in 1866, and the slide on the right shows you the with and upon ledgers, which basically unpacks the 20 bills that I've highlighted on the left and gives you all the details. Now, in terms of what details the with and upon ledger records, it records a specific set of specific information on each bill. For example, where the bill originated and who originally drew up the bill of exchange. And typically in this period, this would have been drawn to finance overseas trade and originated abroad. So there are a lot of international locations on here. It also records the maturity of the bill and, importantly, who was the acceptor of the bill, the person who guaranteed it and to whom the bank would turn for payment when the payment was due. And in this example of the Rothschild's customer ledger, I've highlighted, obviously I've written over the handwriting here, and you can see an entry that Schroders were guaranteeing one of the bills which Rothschild's had discounted with the bank in 1847, and that had been drawn by its correspondent firm in Riga. So clearly the bank was holding a fair amount of information here on the bills that it was accepting, and Flandro and Ugolini argue this allowed the bank to sort of supervise the financial system, monitor its collateral and apply some discretion in terms of who it lent to. And we can use this as the basis of some econometric work that I will show you right at the end. Now, the bank also kept a separate bills rejected ledger, recording all the details of bills that it actually rejected. And again, it contains various bits of useful information on the bill's maturity date, its monetary value, the name of the discounter, the drawer and the acceptor, and the acceptor's location. And in principle, again, this can tell us a lot about the bank's willingness to discount bills and lend to counterparties secured on those bills, and give us information on why particular bills were accepted or rejected. And again, we can do some it lends to itself to econometric work on this. So armed with all that evidence, what I'm going to show you now in the remaining slides of the presentation are some highlights of the insights we've been able to glean from the ledgers based on some standard statistical and econometric interrogation of the data. And as I mentioned earlier, I'm going to use Bagehot's rules as a way of organising that. In other words, I'm going to sort of crudely look at how freely the bank lent, what interest rate it lent, and what decisions it made about the bills it would accept and reject. So if we turn to the question of lending freely, it's probably best to start with how the bank operated following the Bank Charter Act of 1834. Now, many people think that the Bank Charter Act prevented the Bank of England from responding in a financial crisis at all. The Bank Charter Act only allowed the bank to print more notes if its gold reserve increased, and gold reserves typically declined in financial crises. However, under the Bank Charter Act, the bank was split into separate issue and banking departments. And although the total amount of notes issued by the issue department was tied to the stock of gold, the banking department of the bank actually held a portion of those notes as part of its reserve. And that meant during a financial crisis, it could potentially run down that reserve and supply extra liquidity in the form of notes, putting more of the total stock of note into circulation. So for a given stock of notes, the bank could actually put more into circulation by running down its own reserve. Now, as I mentioned earlier, there was actually no constraint on banking departments' deposit liabilities. So just like today, the banking department could in principle lend to the financial system and create deposits for its banking and other customers in the same way that the bank creates central bank reserves for its predominantly banking customers today. Now, of course, that would depend on whether those customers were happy to hold their liquidity in the form of deposits at the bank, or rather than convert them into Bank of England notes or gold. If they did convert them, that would obviously put pressure on the bank's reserves. So in practice, and as we'll see, what happened in these crises is that when the bank increased its discounts and advances, its note reserve would run down relatively quickly. And I'll show you that in a second. Now, before I do that, this slide shows you the top counterparties the bank dealt with in the crisis of 1847, 1857 and 1866. In other words, who was coming in for funds during these crises. And as you can see in 1847 and 57, the main counterparties were bill brokers or discount houses, who many argue were the shadow banks of their time, as they used short-term funds placed with them by the banking system to buy risky bills of exchange or commercial paper. And during a crisis, the commercial banks would typically withdraw the money at call they held with the discount houses, who in turn would then come to the bank for assistance. So in these crises, the bank often operated at arm's length from the commercial banking system via bill brokers and discount houses, although it did discount bills directly from merchant banks, merchants and traders, as we discussed in more detail in one of our papers. So it wasn't exclusively with the discount houses. And as you can see, by 1866, in the lower part of the screen, we can see that commercial banks now start appearing as top counterparties. And in part, this probably reflects the gradual development of large joint stock banks in the UK, which had been prohibited by law until the late 1820s. But it may be significant because the bank viewed the joint stock banks as commercial rivals, and so the fact that it was prepared to offer them discount facilities during the financial crises may suggest it was indeed adopting Bagehot's principles to lend more freely to whichever counterparties provided needed funds, and provided the collateral, the quality of the collateral was good. So let's turn directly onto the evidence of whether the bank did lend freely according to Bagehot's prescriptions during these crises. And as you can see in this chart, the bank does increase its liquidity provision markedly in the crisis of 1847, 1857 and 1866. And as you can see, this was largely in the form of discounts, although advances were increasingly used later on in the period. And as I mentioned, in each of these crises, when the bank did indeed provide funds, what it found was that its note reserve dwindled towards zero. In other words, what people wanted in exchange for their bills of exchange, or what they wanted in return for when they took out a loan, were Bank of England notes. And so what we find is that in each of these crises, the Bank of England's note reserve dwindles very, very close to zero. And so the note issuance constraint under the Bank Charter Act became binding in these crises. And in each of these crises, it ultimately required a government letter to indemnify the bank from breaching the 1844 Bank Charter Act to allow it to print more notes. But in the heat of the crisis leading up to that point, where the indemnity was provided, the note issuance was an important constraint. But once the letter had been written and the bank was actually free to print more notes, that usually ended the crisis. Apart from 1847 and 1866, the mere relaxation of that constraint was pretty much enough to end the crisis. But obviously, when we talk about the heat of the crisis and leading up to that point, the note reserve was binding for the bank. Now, of course, one thing the bank could do, which it couldn't do before 1833, is increase bank rate, which it did, as you can see in the right-hand side of the chart here, which it did to unprecedented levels in 1847, 1857 and 1866. And raising rates, the idea of raising rates, would ultimately draw gold into the country and allow the bank to replenish its reserves and then ultimately print more notes, at least in the longer term. It would also raise the opportunity cost of holding Bank of England notes and offset what Bagehot termed was timidity in the market. So it would encourage market participants hopefully back into holding bills and hopefully alleviate the crisis that way. But a key issue here is whether when the bank raised its rates, it would increase it above the rates existing in the market. This is important because, given arbitrage in the market, lending at a rate below market rates would typically imply that the bank was rationing its credit and rejecting more bills, whereas lending above market rates would imply more of Bagehot's prescription of lending freely at high or penal rates. Now, if we compared the three crises and we look first at 1847, it looks as though the bank, although it did increase its rate, was actually discounting at rates that were typically below those prevailing in the market. So it seems to suggest that the bank was rationing its discounts in 1847 rather than sort of lending freely at a high rate above, operating above that in the market. And this doesn't seem to happen in 1857 or 1866. In 1857, bank rate was typically increased to levels above those in the market, and the same is true pretty much for 1866. And what that suggests was that the bank was rationing a lot more during the 1847 crisis. And this seems to be confirmed when we look at loan rejections, i.e. what proportion of bills brought in for discount were refused by the bank. As we can see here in 1847, the rejection rate was much higher than in 1857 and 1866, suggesting at face value the bank was actively rationing credit during this crisis rather than lending freely, but gradually became more willing to lend at high rates in the later crises. So there are snippets here of evidence here that the bank was evolving towards Bagehot's prescription for lending freely during these crises. And so let's finally turn to the collateral policy of the bank and the sort of third leg of Bagehot's prescriptions. What was the basis for the bank's collateral policy? Was it lending on good collateral, good quality collateral? Now, even when it was lending freely, what drove the bank to accept and reject different types of bills, and what information did it use? And we try and do this in two ways. Firstly, we just look at some very simple high-level statistics on the performance of the bank's investments alongside other informal evidence. But what we've also started to do now is some econometric work on the samples of the packets of bills I showed you earlier, which looks at the identity of whether the identity of the discounter matters and what characteristics determine whether a bill was accepted or rejected. And I'll show you some of the preliminary econometric results we have from an analysis of the 1847 crisis. But first, if we have a look at some metrics on the bank's liquidity and collateral management, one thing we find is that the bad debts on the bank's book were relatively low in each of these crises. So actually, when the bank was discounting bills, the bad debts on the bank's book were typically low. And we also see that in terms of bills that were late for payment, which is another metric that declined markedly over the three crises. So in one sense, the bank was operating good collateral management on that simple metric. Similarly, another metric is the bank's profitability. If anything, the bank's profits rose during financial crises. And so again, there's evidence here that the bank's, whatever the bank was doing, it was doing a reasonably good job of assessing the risk of the bills that were coming in. Now, what underlay that apparent success? Well, this goes back to the earlier issue I mentioned about frosted glass and whether the bank was using rules based on particular characteristics of the bill brought in. Was that what it was doing, and was that what underlay its success? Or was it using more discretion, where it took into account all that information I showed you about all its potential counterparties in making a judgment about who to lend to? Now, one particular well-known rule that the bank followed was that it would not deal in bills of a maturity longer than 3 months or 95 days. And you can see here that the average maturity of the bills the bank dealt in was well below that and close to 2 months on average. So obviously, management of the maturity of the bills it was dealing with is one thing that the bank was doing. We also get an idea from the ledgers that the bank was increasingly using more of the information in its ledgers to monitor the financial sector. And here is an excerpt I've taken from Baring's customer ledger in 1866. And what we see is that the bank starts doing these sort of cumulative exposures to Barings in the ledgers. It was often subtotaling how much of its exposure it had to Barings at various points as bills came on and off the bank's balance sheet. And we don't see these subtitles in the 1847 or 1857 ledgers as far as we can judge. So it does suggest the bank may have been improving the details it records in its ledgers, leading to better management of its collateral risks. So the ledgers are a monitoring device as predicted by and as espoused by Flandre and Ugolini in their work. A further informal insight we get from the archival evidence is that often counterparties would come in to get their collateral assessed well before they needed help or assistance. And we have an example here from an excerpt from the diary of the Deputy Governor in 1857 called Bonamy de Brie, where he writes that he's visited by a counterparty, Hall Barnett and Co., saying that they might need a loan at some point in the coming weeks of between £150,000 and £200,000. And they come in and they bring in a set of securities for the principal of the discount office to look over, who then looks over the bills and says the bank will be prepared to make a loan on the quality of the collateral that he can see. And lo and behold, later we actually see those two loans granted in the discount ledgers that I showed you. So the we see two loans granted to Hall Barnett and Co. amounting to just £200,000. So the action of coming into the bank a few weeks earlier and getting the collateral ticked up meant they got their money. Now, of course, today we would call that a rather informal degree of pre-pledging of collateral. And it suggests that this sort of informal pre-pledging of collateral was one way the bank was also able to manage its risks. And finally, just to wrap up the presentation, I also wanted to show you some initial regression results we had done. As I mentioned, the information that we have in the bank's ledgers allows us to look at both at a packet level in terms of the characteristics of the discounters coming in to get assistance, but also at the bill level. In other words, what was the various bits of information and characteristics on the bill various on the bill that the bank collected, and use that information to try and determine the probability that a bill might get rejected by the bank. So we can use all that information to do some econometric analysis on the probability of bill acceptance and rejection. Now, as usual, I've done the usual thing in a presentation of flashing up a large amount of econometric information on a screen that you can't easily read. But what I'll try and do here is give you some of the key takeaways from these initial regression results. And these are things we're actually working on at the moment and trying to improve. So these are sort of initial snapshots of the results. Now, the key takeaway when we look at our analysis of packets of bills is that the identity of the discounter does appear to matter. The discount window is not a completely frosted glass. In particular, we find that bill brokers or discount houses appear to be discriminated against in general compared to other borrowers, and even more so in crisis weeks. On the other hand, we find that commercial banks are less likely to get bills rejected in a crisis, when that lending constraint, as I showed you, was most binding. We also find that firms that eventually failed, and those involved in the corn trade, which was an important part of the crisis in 1847, had a higher probability of their bills being rejected. Now, obviously, cause and effect are unclear here, but it does suggest the bank rejected bills of those firms that actually failed. So it might tell you something about the prescience of the bank in terms of solvency, although causality is obviously unclear here. When we actually then look at what we call our bill level regressions, and try and look at whether the probability a bill was accepted or rejected based on the attributes of the bill, what we find is that certain key characteristics matter in particular. Firstly, the location of the acceptor is particularly important. In fact, bills are much less likely to be rejected if the acceptor was London-based. Secondly, and corroborating the evidence I showed you earlier on the average maturity of bills the bank was discounting, higher maturity bills were more likely to be rejected. Thirdly, bills with a Bank of England director as an acceptor were also less likely to be rejected. Now, importantly, what we're also able to do is compare whether those characteristics or rules change between crisis periods in 1847 and non-crisis periods, weeks where there was less pressure on the bank. And what we find was that those characteristics were unchanged, suggesting evidence that these rules on the characteristics of bills were upheld even in the severe moments of the crisis. We also have some evidence at a bill level that corn-related traders actually faced a bit less chance of rejected bills in crisis weeks, suggesting that they were able to get some finance or some help, in particular in crisis weeks, even if on average they were being slightly discriminated against compared to other borrowers. So those are some of the initial snapshots we've had from our regression results. And just to summarise all of that, firstly, it does suggest the bank did take the identity of borrowers into account in 1847. The glass was not completely frosted. Bill brokers seem to be the sort of bad eggs that the bank was not keen on lending to or discounting to in a crisis, and perhaps that foreshadows their exclusion or their temporary exclusion from discounting facilities following the 1857 crisis, which is something we discuss in one of the papers. And there's some evidence, as I mentioned, the bank is prescient on solvency, although our regressions can't really tell us much about causality, so that's very much a provisional conclusion. Secondly, it appears the bank acted with a mixture of rules and discretion. So rules on the quality of bills accepted in terms of maturity, London names and BoE directors. These all actually corroborate contemporary and secondary accounts that these were actually the characteristics that mattered and the rules under which the bank would typically accept or reject paper. But there was discretion over who got funds in crisis weeks. As I mentioned, banks and those worst hit by the crisis did seem to be favoured at the expense of bill brokers, and we need to do some thinking about what actually underlay that. Now, one issue here is that obviously the Bank of England during this period is a private sector institution still, and it viewed the banks, the joint stock banks in particular, as competitors. So the fact that it was willing to lend to those counterparties during crisis weeks does suggest some elements of lender of last resort behaviour, according to Badgett. But again, that's a provisional conclusion, and we're continuing to do a bit more work on this. Now, one note of caution on these results I should add is that they're based entirely on discounts at the bank's head office, and it excludes any discounts that were made at the bank's branch activity. And as you can see here, a significant amount of the bills discounted by the bank during these crises were done by the bank's branches. And so that might call into question some of the results we're getting on the bills that were presented to the bank's head office. In particular, the statistical finding about the importance of the London location of acceptors may just reflect a bias in the surviving data, and that's one thing that we need to be aware of in analysing the results. So just to finish off, I just wanted to offer one rather superficial piece of evidence on how overall we might evaluate how the bank's procedures worked in the 19th century. And one simple metric is the damage inflicted on the economy by financial crises. And what you can see here is real GDP growth based on Steve Broadberry and others' data for Great Britain and Great Britain between 1790 and 1870. And what we can see in terms of real GDP growth is that in the crises after 1847, the hit to the economy in terms of the downturn of GDP growth was much less than earlier crises. And I've obviously circled the financial crises in red here. So if we look at the GDP hits during the 1847, 57 and 66 crisis, they progressively get better and are better than the experience of earlier crises in the 18th and 19th centuries, suggesting that the bank's handling of these crises, whatever it was doing, improved the outcomes. But obviously that's a relatively superficial piece of evidence, but one I think that's worth making. So just to wrap up and conclude, I think we do see elements of our current post-crisis framework in the bank's lender of last resort behaviour in the mid-19th century. The bank's monitoring its counterparties, evaluating credit risk. We see some evidence of pre-pledging of collateral. And what we see is the bank is acting with a mixture of discretion and rules. And so what we see are that rules on bills, we see there are various rules on bills, whether bills are accepted or rejected. But we also see some discretion over who got funds in a crisis. And this is work that we can continue to work on, and hopefully in future work we'll be able to evaluate better with the econometrics in terms of what those characteristics and evaluation methods were. But that's hopefully a summary of where we are with this work. And with that, I will leave it there and hand back to Juan, and I'm more than happy to answer any questions that people have. So thank you very much.